Welcome to TheoTrade. This is Don Kaufman, November 15th, 2023. Just about 10 minutes to go to the cash close here on this Wednesday afternoon. For the most part, well, once again, we're seeing the S&Ps trade massively unchanged. We had some more critical data points coming out this morning. Of course, we saw some softer data. Softer data, though, and overall, a much stronger marketplace. Of course, we're going to call that into question to some degree here momentarily. But first, let's get to some of the intraday trade. I mean, today's session, well, it all comes down to the fact that the PPI and retail sales numbers came out. Look, I'm not here to talk about the data other than to say retail sales came in a little bit softer. PPI, you can argue, kind of came in line. Obviously, the CPI number, right? We're at alphabet soup over here, but CPI came in yesterday a little weaker, okay, and had a spectacular rally to the upside. Look, time out. We'll worry about that in a moment. There's a few things that really are bothering me in today's tape. So before I get big picture on the overall market, we talk about softer data and a stronger market. Okay, before we get there, take a look at today's tape. So the S&Ps are technically, they're up. Okay, they're up and mildly so, and maybe a little sell side activity coming into the close. But as you look down the tape at some of the usual suspects, the real standout here is the bond market. The bond market, first of all, in terms of volume, it's absolutely rocking out there in terms of volume inside of the bonds. It's volume inside of the notes. I mean, almost like record-breaking volume in here. In fact, if you look at the bond market has now given back about half of yesterday's up move. And I'm going to tell you right off the bat here, okay, why I look at this and I'm like, this kind of bothers me. What bothers me out of the tape? So if bonds are rallying, just hear me out for a second. If bonds are rallying, banks, okay, that have substantial unrealized losses because of bonds, those banks should technically rally. Now think about this huge sell-off inside of the bond market, all of a sudden pop back to the upside. And as we saw the pop back to the upside, take a look at like some of the regional banks. This is KRE. KRE, if you're unfamiliar with it, it's the Regional Bank ETF. And the reason I wanted to bring it up is because look at the magnificent pop. Okay, kind of came off a little bit and popped again to the upside. And I'm going to tell you one of the things that really bothers me. Today, it really bothers me the fact that KRE is up. How is KRE up today? And not up a little bit, it's up like 1.5%. Because that bond market, that's not being friendly, is it? Not even close to being friendly. It's down 1 in 11 ticks. So what you have over here is a little bit of a catch-22. You start to look at individual stocks that are very bond market sensitive. I'm not trying to pick on Charles Schwab. You don't have to pick on Charles Schwab. They have, well over between, who knows, $25 to $35 billion in unrealized bond losses. But lo and behold, the stock today is actually up some 2.5%. Think about that, okay? Think about that for a second, because is that actually healthy? No, all right? And at this point, you're seeing this dramatic disconnect, and that's the point I'm trying to make. There's a dramatic disconnect behind, if you will, that fundamental logic, if you will, of bonds and the banks right now. But again, lo and behold, I mean, I guess somebody can make the argument, well, if the bonds are selling off, interest rates are going up. And if interest rates are going up, then the banks should do well. Yeah, but unrealized losses is what everybody's concerned about right now. Okay, and I get that. So that's one of the things that really bothers me inside of today's tape. Also, volatility. I do want to mention this. Volatility has seemingly found maybe a little bit of a floor here at the 14 level, which is pretty amazing given the fact that there's still some significant geopolitical risks going on in the world. Obviously, oil has come off quite substantially and continues to come off a little bit. But nevertheless, again, the home of VIX, okay, lying dead on the floor is probably somewhere right around that 14 level. And even with today we saw quite a degree at one point of an up move. S&Ps were actually approaching, up like 24, 25 handles. The VIX never really backed off too significantly and has kind of been on the bid throughout the course of the day, but ending the day back massively unchanged. You can actually look at VVIX. VVIX is actually bidding a little bit higher in this, which, hey, rightfully so. There's some slippage in the marketplace. VVIX should come back up. All right, so again, just the bigger picture for today, in today specifically, happens to be, lo and behold, just the fact that I don't like the price action in the bonds, because the bonds at this point are still just a hop, skip, and a jump. Like if the bonds just sell off another like 2 points from here, maybe 3 points, we're right back in the exact position where, oh my gosh, interest rates. And I have to tell you, and again, this is completely my opinion in here, but if you start looking at the TNX, okay, yeah, I still have to say that we got to crack through that 5% before this could be all over. And I want to be mindful of just that. Now, let's go to a much bigger picture, longer time frame. All right, let's go over to the spiders for a second. So lo and behold, it's a spectacular, what I would term, volatility to the upside move. And followed by yesterday's CPI. I mean, yesterday's CPI is pop to the upside. But you really want to think about this, not right here, right now. So I trade and I invest, and my trades, okay, they can be shorter term. I mean, trades can be anywhere from, literally intraday, a few days. Okay, a lot of the stuff I do in terms of premium selling, though, I go out a couple of months, but the average hold time for a trade can be like 30 days, so forth. But with investments, I have a big issue right now, and I'm going to tell you exactly what my issue is with investments. First of all, I have investments, and a lot of my positions happen to be short. Hope that's okay with everybody. Yes, I carry short positions, which has not been lovely from this 410 to this 450 inside of the spiders. Not even a little bit lovely. But the way I look at it is, look, I was short back here when we were trading, 450. I was short down here at 410, and yeah, I'm still short here at 450. So it's a give and take relationship. But the thing that really grabs me, okay, about the data, again, the data that's coming out right now is, generally speaking, weaker retail sales, and we applaud it. It's weaker in terms of CPI, and we applaud it. But if you looked at the PPI numbers, the only thing that really backed off in the PPI numbers was actually fuel prices, gas. That backed off. Everything else was actually steadily increasing still. So people, we are really in a huge just catch-22. You're actually looking at a marketplace that's seeing weaker data, and you're applauding it by rallying. Okay, and that's because the market, it just does not care about fundamentals in the near term. It's all about hooked on the juice. Am I going to get something for free when I'm talking about interest rates? It just wants lower rates, because everything becomes at that point an interest rate kind of carry trade. So in the near term, yeah, it's really bullish for the marketplace, but immediately you're going to see the media completely switch gears, and now all they're going to talk about, is it a soft landing or is it a hard landing? Well, considering we've never really had a soft landing, let's go with hard landing, which implies it could be a rough ride ahead of us. Now, does that mean to the end of the year? No. I mean, look, okay, Santa come early this year. Let's assume that this was already the Santa Claus rally. But the other aspect that I really want to resonate with you is simply that it's one of the most wild, okay, moves in terms of historical volatility to the upside. And you can actually quantify that. You can come over here to studies, you go add study, you go volatility studies, right? And there's implied volatility, which is, forward looking, that's what options, but there's also historical volatility. Historical volatility, the annualized standard deviation of past stock price movement. And one of the things I want to point out, the term volatility needs to change in your mind, because wow, are we volatile right now? But we're volatile to the upside, even more so than we were when the S&Ps were actually selling off. And I really want to drive that home, because for everybody, okay, that's involved in this business that barks about, look, the VIX is back down at 14. I'll tell you time and time again, the VIX is dead as dead can be. That's my, predecessor's volatility indicator. Right now, as we come into the closing bell here, right now, you got to be a little sharper than that. You got to start looking at stuff like historical volatility, which is actual price movement. And I'm going to be honest with you. Actual price movement, and there's the closing bell. Actual price movement, absolutely rocking right now. Where you been, okay? The price movement is almost right now where it was okay, when we were absolutely tanking. In fact, I'm going to open up 3-year daily because I want you to see this is a vicious and unrelenting bear marketplace of last year. And yet we're incrementally getting up there right now, and it's done on a rally. Think about volatility, because I'm going to tell you right now, that volatility is not over, not by a long shot. And if you actually look objectively at it again, yeah, the marketplace is getting stronger, but on weaker data. Good is bad, bad is good. When is good going to become good and bad going to become bad? Things were so much easier that way. That's how twisted around the Fed really has us. All right, last but definitely not least, we cover this each and every Wednesday. We take a look at expected move. An expected move, look, there's nothing to say here, but we're home. All right, so on Monday, we did absolutely nothing. Tuesday, we CPI'd our way to outside the expected move. The expected move this week was just shy of about $64. It was plus or minus about $64. Here we are right now, outside the expected move. Okay, let's take that down to intraday. We take a look at this on an intraday basis. If we fade here, we only have to fade by about 20 points to come back to the edge of expected move. We're in a very, and I want this is the big takeaway here. Look, we're in a very precarious place in the market, right? And the reason we're in such a precarious place is any upward momentum, and everybody has to hedge in the direction of the marketplace. What that effectively means is if we rally just a little bit on any more of the data that comes out, and yes, there's more data coming out, there's bond auctions, oh my, right? But any more data that comes out, yeah, that could perpetuate another significant rally, not because anybody's bullish, just because hedging activity drives us. On the flip side, though, a little bit of sell side activity is just going to drive us right to the lower edge of the upper edge of the expected move, which is 44.80. Okay, 44.80. I would suggest that coming into tomorrow, it's obviously Thursday, Friday, I think we're actually going to see just that. I think we're going to see a 44.80 print. And again, we still have to deal with, well, more economic news coming out. Again, it's a little bit of a free-for-all and jobless claims. Look, this stuff can move markets right now. And I keep stressing to everybody, this week started off with a bang with CPI, a little PPI and retail sales today and Wednesday. Things kind of, were quieting down a little bit, okay? But there's still enough Fed speak to rock these markets. So keep your hands and feet inside of the vehicle at all times. Again, I think we're actually going to see the upper edge of that expected move come into play, SPX 44.80. That is it. Thanks, everybody, for joining us here at TheoTrade. Have a wonderful evening. Bye-bye.